folks, hope you're well. Someone in Discord last week had asked me to look at some analysis from another analyst and around their views on Bitcoin and the potential position in the cycle. It was quite interesting having a look through it, and I'll cover off who the analyst was and point in their direction later, so as not to be claiming any of their work as my own. And I said yesterday when we were having a discussion on what potentially comes after the bull phase of this market that I would put together a video with my thoughts on all of this, just to try and make it clear where my head was at and some of the things that I'd said. It's easier to cover it in a video than to go through it in writing on Discord. It's probably going to be a little on the longer side, this one, because I'll be jumping around a little to pull together a lot of different things that I've spoken about within the server over the last couple of years, and some of the videos I've done recently around election cycles and potentially where we're at. But I'll try and keep it as short as possible. So to start with, I'm just going to remind you of, from a Bitcoin perspective, my primary thesis at this point is this one on the screen that we've spoken through a few times. So I think we're most likely in the fifth wave of the outstanding fifth wave of an Elliott cycle, which started in 2019 and included the previous Bitcoin bear market. So this bit in the middle for a wave 4 is a flat expanded, in my opinion. It falls right between the 1.618 1.786 of the A wave is where the C wave comes down to. Doesn't break any Elliott rules in terms of the 4 coming back into 1, and structurally it just fits quite nicely. So if I show you what I mean by that, so this is a flat expanded schematic. So it's a 335 schematic where the B wave exceeds the top or the initiation point of the A wave, and then the C wave is a 5 wave move down that exceeds the low of the A. The internals of the measurements, or the internal fractals, as you can see on the schematic, there are zigzags, combos and flats, ultimately with the final one being an impulsive or an ending diagonal. So if we look at that structure, I think it's quite nice as an ABC 3, 1, 2, 3, 4, 5 impulsive down. So I'm not going to go into too much detail into this. I have got further analysis on the internal structure of this, but I think I've covered that enough that I'm comfortable where we are with that one. So with that being said, my general thesis has been for a while that from the bottom here, so the orange is the primary, the yellow is the secondary, and the pink and whites in here are the tertiary levels within this wave set. So 1, 2, 3, 4, 5 with a little flat expanded in there again for a wave 1, a flat ABC for a wave 2, and then my view is we're currently in a wave 3, so 1, 2, 3 with an outstanding 4th and 5th of a larger 3 with a 4 to come, and then a 5th to come after that to give us our high. And I've spoken about this as the potential for the two top cycle, like 2013, and one that could catch people out by the first one coming on the left and the second one coming on the right, potentially. Now the reason the analyst I was pointed in the direction of was quite interesting is that we've got a kind of similar thesis on the flat expanded 4 in there, and where we are in this cycle from a tertiary perspective, if you like, but he's got a very different view on how it looks from a macro perspective. So I want to just kind of cover that off and go over it. So in terms of the measures here, somewhere between 95 and 115 is where I'd be looking at for this final impulsive wave of the tertiary based on the measures internally. So it fits with the way that I measure internal waves and provide targets for those. So the analyst that was pointing in the direction of, just to give them a shout out, was a guy called Pip Snipers. So you can check out his YouTube channel. There's a lot of really good content on there. It's at PipSnipers, and his X is at PipSnipers as well. Again, a lot of good information on there in terms of his analysis. We're very kind of similar in terms of the way we do things, which I think is why I was pointing in his direction, and that it's Elliott wave with a little bit of ICT and Wyckoff sprinkled within it. It was quite apparent as I was watching a few of his videos and listening to him that he's got the same view of the ICT concepts as I do, and some of the language he used was quite gave away that's the kind of style that he uses. So it was interesting to watch. Go check him out, and we'll have a look at what is his thesis or my interpretation of his thesis. I'm not going to steal his content by using his videos, but the content I'm about to show you is my count of his idea, essentially. So and that idea is that we're actually in an ending diagonal rather than the macro 5 or larger 5 that I have us counted within. So that would look something like this. So going right back to the start of Bitcoin's history, make it fit on the screen. So wave 1 and 2, 3, 4, with this being a 5 wave ending diagonal that started in 2015. So straight away it got me kind of interested, because I've always had, and some of the analysts in the Discord that we speak about this behind the scenes, I've always had issues with this whole section here and the way that you count it and how you make it fit with Elliott rules. I've never been hugely comfortable with it. The thing that jumped out when I watched the video and I started counting this out myself was it actually fits really well with an ABC. This corrective in the middle, it looks quite short, but it's actually 38% or something along those lines, I think, from memory. So it looks short because it's on 38%. It looks short because it's on log scale, but it's actually a fairly sizable correction there. And as a zigzag with a 1, 2, 3, 4, 5 ABC, 1, 2, 3, 4, 5 for the larger ABC, it actually counts better than most of the internal impulsive counts that I've been able to find on that. So that jumped out at me kind of straight away. The second thing that I looked at is the way that I measure waves, and for those in the Discord, the way that Quads and Raf measure waves as well. The 3 here with this is a 1 was within the area that we'd expect a 3 to be, and interestingly, based on the 3 and how far that went, the projected area for a 5 is within the projected area that an ending diagonal would give us for this wave. So traditionally you would kind of see the ending diagonal top fall just below the top trend line, so we just kind of roll over below that top trend line, which I think is about 115 to 117k, something along those lines at the moment. And then when you follow the structure through, so I'll show you what diagonals actually look like. So this is an end diagonal, just as a schematic, just to kind of show you how it looks at the end of it, so you can get that in your mind. And the one we're looking at here is an expanding one. You could have made a case for either, but I think it is probably the expanding one based on the way that it looks. And we can see there it's a 3-3-3-3-3 construct as an ending diagonal, if you can see here, and it generally comes in an impulsive 5th wave, as you would expect. So just bear the schematic in mind when you look at the chart. I just want to show you that now. So 1, 2, 3, 4, 5 ABC, again the internals work quite nicely. ABC to the first top, ABC to the bottom, and this is where it gets interesting. So my primary thesis, if you remember, was we're in a wave 5, which is the same as this would suggest, so in a wave 5, but my count of that wave 5 would be a macro 5 wave move, of which we are in wave 3 with a 4th and a 5th of wave 3 to come. Now where this has given me some cause for thought is that this would be essentially a 3 wave move rather than a 5 wave move at that macro level, so the A, the B and the C. So where I had this marked as a 1, 2 and it's currently been in a 3 with a missing 4th and a 5th of that 3, in my primary there would then be a further 4th and 5th to come after that. In this scenario, if this were to work out the way that it's mapped, it wouldn't have that final fourth and fifth, because the 1 and 2 that I have marked are actually an A and B, and what we're in now is the 5-wave impulse of a C, with this being a larger zigzag, essentially zigzag family correction. So 1 2 3 4 5, 1 2 3, 1 2 3 4 5. So what that would mean for me is I could be looking for one wave too many, or one wave that doesn't come. So obviously I'm looking at that and thinking, well, there's a risk in that I need to acknowledge. There's nothing that I can look at within this analysis from an Elliott perspective to invalidate it. I've been through it quite a few times. The structure is quite nice within it, so I think it is a valid structure. So this presents a real risk for me within my analysis. So I'm not going to change my primary expectation, and to be honest, it's close enough within this final one that I don't really need to at this point in time. But I need to be cognizant that the fourth and fifth that I think may come as part of that analysis may not if this one is right. So it's certainly given me food for thought from a risk perspective. And as with all of this, I think it's going to come down to the timing. I think, as I've said a few times in the Discord, I think towards the tail end of this year, worst case Q1 2025 is when I expect to see what will be the eventual cycle top come, so earlier than normal. If we start kind of hitting these levels in this structure within that time frame, I might have to have a look and see how that plays out. So just to kind of show you the end here, so that the end bit of this is essentially the same. So if I put let me see if I can get the Elliott on there. So yeah, so that's the Elliott that I'm looking for at a tertiary level, with, if I find the right one, there. So that's where we differ. So we're the same here and here, and we're the same on the internals of this one, but Pip Snipers' view, as an ABC, it would stop here. So where I've got the third marked and then the fourth and fifth to come, if it's an ABC, it stops here. The internals of A and C are the same in terms of the way that we've mapped them out. The only difference is this bit wouldn't happen. So you can see the risk that I'm kind of getting at there from my perspective. Now, where we're at within this 5-wave set here, the measurements on this are still quite nice. The projection, again, as we do it based on the one. So look at that one. What's that one? I'll just do a new one. It's easier. So based on the one, at a rough level, we've seen the 3 exceed the 1.618. So we would be looking for kind of 2.618 for the 5. Let's get the right one. When I did this the other day, it was there, 115. So that's the one I'm looking at. So and yeah, so that falls kind of right in that area of just below the top trend line for the end and diagonal. It meets all the kind of rules that you'd look to for within that, and it falls within the area that we've been speaking about for a long time, which is between that kind of 94 and 124 type area, with an outside chance of a blow off to kind of 149-ish, give or take. So yeah, just some quite interesting analysis. So risk there from my perspective, that I'm looking for one wave too many, and I need to be aware that might not come. So I'll track both of these going forward. As I say, I think it's good analysis. I like the content, and that was what I was talking to people about in the Discord the other day. And one of the things I mentioned on that was what potentially comes after, because that then becomes the next risk that I move on to look at. So in my scenario, I'll put that one back on, take that off, put this on. So in my scenario, you'd be looking at a corrective at the end of these waves, and larger scale corrections usually correct to somewhere within the fourth wave of the previous parent set. So if this internal yellow, the 5-wave set is the child, then the correction you would look for at the end of that would be somewhere in this wave 5 area. Now, there are occasions where it takes out all of wave 5 and drops back to kind of wave 4 levels. So I'm going to read this out, but you can pause the screen and have a look if you want. But essentially what it says is, expect it to correct somewhere in the zone of wave 4, expect it to correct somewhere in the zone of the macro wave 4, and it can go all the way and take out the entire wave 4. So that's all I want to highlight that in terms of Elliott rules. But generally I would expect it to correct somewhere in here. The first levels I'd be looking at would be 382, the 50%, and then the golden pocket between 618 and 786. Now, how that looks from a corrective perspective, if this was the scenario, so 1, 2, 3, 4, 5, we'd be looking for it somewhere in this area of 4 to 5. The 382 is around 64, the 0.5 is around 49, and in that pocket is 618 to 786. So these are the kind of levels that people are talking about for a corrective that comes after this cycle is finished. I think a lot of people think that below 30 is never going to happen, but it still sits within the pocket, depending on how high we get. Obviously, the higher we get as a top, the higher this goes. But the general kind of thing to mention, or the general point I'm making with this, is if this was right, and this was the grand cycle, or this was the primary cycle, then the correction would be somewhere between 64 at this point and 25, with an outside chance of going lower than that. But most people don't think that's possible. So the reason I raise it is, in an ending diagonal scenario where the primary is much larger, so your wave 4 essentially starts at $265 for this wave 4 in this scenario as an ending diagonal. So that primary that I had in terms of 1, 2, 3, 4, 5, this is an internal at that point, and this is the larger cycle. So if we look at where that might correct in those terms, your 382 is at $9,000, $9,500, 0.5 at 43, and then the golden pocket 2019 down to 669. So I'm going to say right off the bat, I'm not projecting that that's where this is going to correct to. I'm not saying that's where we're going with Bitcoin. I don't make projections or predictions as the guys in the Discord know. I basically say this is structurally how it looks, this would be where it fits structurally within those rules, and these are the invalidation points for that. Again, the reason I raise it is, if that's the range that I've got marked there for a wave 4, then these would be allowable Elliott corrective levels for that scale of correction. So then the question becomes, have we seen anything like that before that we can look at and say, on that scale, is it even possible for it to correct that much? And one of the things I've raised a few times is the internet adoption cycle. So very similar to Bitcoin, I've used it talking about left translated and right translated cycles. From an Elliott perspective, it maps roughly like that. I've got lower level detail on it, but I don't want to make this chart too messy, so I've just shown kind of the rough high levels of the wave counts. Very similar to Bitcoin in that it had 16 years, 4 distinct 4-year cycles, the first 3 all right translated, with the potential for the Bitcoin 4th cycle, the 16th years, or the 16-year part of it, to be left translated, the final 4-year cycle, where the NASDAQ internet adoption boom was left translated for that final 4-year cycle. And if we look at what happened after that, it took out that entire macro wave 4. So have we anything we can look back on historically to say it's possible? We do. It's the easiest one to look at. It's one that's compared to Bitcoin a lot. It's one where that whole kind of left translated, right translated conversation started, and as you can see here, the retrace on that was far longer in time wise than any other cycle correction, and it retraced the entirety of the 4th wave, which I mentioned was possible earlier. So is it possible? Yes. Is it where I'm looking at the moment? No, but it's something we need to be cognizant of as a risk, and we have this historic data to look back on from another market, a market not so volatile as Bitcoin, where it's done this before. So is there anything else we can look at in terms of what might drive that? So again, I've spoken a lot about over the last kind of 2 years around election cycles and where the bottom might come, where the top might come, and my view on whether the Fed would cut rates in 2024 or not. So I think as far back as the middle of 2023, I was when markets were predicting 4, potentially 5 reductions this year in 2024. My view was that we wouldn't see any reductions in 2024, and it was based on this chart, which again, if you're in the Discord, you'll have seen this a few times. If not, I'll kind of talk through it. So from a recessionary perspective, if I look back, and I've gone back as far as the 80s, I've not gone any further than that, but I think it's enough historic data to look at for this analysis. The unemployment rate, the Fed funds rate, and the 10-year 3-month yield curve have been fairly key indicators of recession during that period. So there have been a number of recessions during that time, so 4 I think officially, or 5 officially during that time, and in all of them these 3 indicators have followed the same pattern, and only once all 3 hit their levels does the recession follow within a certain kind of time period. So it's not instant obviously, but within a certain time period it follows. So we've already seen the unemployment rate at this point anyway bottom out. It bottomed out kind of April last year. We've already seen the yield curve inversion start to turn up. It had a little turn down again in the middle of towards the end of last year, but it's turned up again, so it's bottomed and is on the way up from a 10-year 3-month perspective. So the final thing we're waiting on now is the Fed funds rate topping out and starting to roll over. And as you can see in this chart, whenever those 3 things have been true, the unemployment's bottomed, the yield curve has bottomed, and the fund rate's topped, a recession's always followed. So I think the Fed are aware of that. I think they're kicking the can down the road as far as they can on that one, using the inflationary pressure as the reasoning. But at some point the expectation is that they will start to reduce the funds rate, and unless history doesn't follow the way it always has, as soon as they start to reduce that rate, markets will react and a recession should follow if history repeats. Now again, none of these things are guaranteed. It's never going to be this is definitely going to happen, but given that the sample size that we have at the moment is 100%, we have to weight probability in the favour that that's going to be the case. So what could be the external driver for a much larger drawdown in Bitcoin to match the much larger drawdown that we saw at the end of the 16-year internet adoption cycle? Well, it could be that recession coming in. Now, I know there's a lot of Bitcoin folks that are of the opinion that Bitcoin is the flight to safety, and that it may have the opposite effect on Bitcoin and it may drive it higher because that's where money may go. I'm not there yet from an analyst perspective. I look at the data, not what I think it will do, and all the data so far tells us that during downturns, I don't really want to use COVID as an example because I'm still quite surprised that they actually called an official recession in their data during COVID, but it's the only example we have. And during that time period, Bitcoin acted like every other risk asset and sold off. So if we look at the data, the history of Bitcoin, and we compare it to equities, Bitcoin tracks very closely with equities. So I understand the sentiment in terms of Bitcoin could become a flight to safety, but that's all it is for me at this point, is sentiment. And the data says historically Bitcoin has not been a flight to safety. It's been a risk asset, the same as every other risk asset, and if risk assets are corrected, then Bitcoin will correct as well. So that's from a probability perspective kind of where I look. So yeah, interesting to say. It's been quite a long one to go through go through this, and credit to Pip Snipers for the detail. It's certainly one that's made me think, and I don't follow a lot of other analysts, but he's one that I'll follow going forward. I think he's got quite a similar style to mine, and I like it when my ideas are challenged and I can look at them without my own bias and think, you know what, that could be right, and I need to be cognizant of the risk in that one. As I say, I'm not going to change my primary viewpoint at this point in time. I think I'm still here from a count perspective, but given that there's nothing that I can find or show that invalidates the alternate view, I'll certainly be tracking it alongside this one. And if I start to think that, you know what, mine is not as likely to play out as the other, then I'll flip to that one without any hesitation, given that the count is something that I can get behind from an analysis perspective. So a couple of things just to summarise then, in summary for that one, is either way we still see a top to come, I think, in my view. I think that top is likely to be faster and stronger than a lot of people are anticipating, based on many things, from the election cycle that was spoken about previously to the comparisons with the NASDAQ internet adoption cycle and the large blow off that came at the end of that. So a blow off top is what my expectation is, or my primary analysis is at this point. That's what I'm planning for, and that's what I'm positioned for. The internal tertiary waves here, in terms of the pink one that's on screen, is the same from both sets of analysis, mine and Pip Snipers. So I'll keep tracking those, and then I'll make a decision later based on whether I exit everything at that point or just a portion, as was my original plan, to try and play that fourth and fifth that I was looking for to come after. A lot of it will depend on timing when it comes. You know, if we, as in the last video, we're in a decennial year for a presidential cycle, and often in a decennial year the corrective from kind of May to June is deeper than in standard presidential cycles. If that deeper corrective comes into June and we're still kind of pushing into November, December, and a top comes in November, December, I think I would need to look at that and say that we're kind of where I would expect us to be, and this is probably time to take a lot of risk off the table. So yeah, that's us. Just some risks to track. A shout out to some other good analysis, some information on the potential for deeper risk at the end of this cycle, which was the comment that prompted the video yesterday when someone asked why I thought it would potentially be the angry phase of the market this time around. So it's that potential risk that could make it angrier. It is just that, it's a potential risk. We manage it, we follow it, and we position as best as we can for it. So that's it. Hopefully it's been useful. Any questions, as always, give me a shout in the Discord, and until next time, take care. Until next time, stay safe. My tea's it. Gotta go.